They didn't announce it on a stage. They didn't ring a bell on Wall Street. They didn't warn the markets at all. But somewhere inside a Samsung lab, a single specification quietly flipped the future of energy upside down. And while traders were staring at red candles, while algorithms were slamming paper contracts, while headlines screamed bubble popped, the real story slipped through unnoticed. Here's the uncomfortable truth. Price charts can lie. Physics doesn't. Right now, the silver market is being treated like a casino chip, pushed, smashed, and shaken by leverage and fear. But underneath that noise, something irreversible has begun. A technological shift so fundamental that it doesn't care what JP Morgan thinks silver should be worth this week. And that shift starts with one simple problem. Fire. For 30 years, our world has run on lithium-ion batteries, phones, laptops, electric vehicles. They all share the same weakness, a chemical time bomb hiding inside the anode. Charge too fast, cycle too often, or stress the system just a little too much, and microscopic lithium needles begin to grow, dendrites, invisible, unstoppable, fatal. They puncture the battery from the inside, triggering short circuits, thermal runaway, and headlines nobody wants to read. That's why EVs charge slowly. That's why range collapses in the cold. That's why solid-state batteries have been called the holy grail for over a decade, and quietly written off as impossible, until now, because Samsung didn't try to outsmart the problem with software. They didn't tweak the voltage. They didn't slow the chemistry down. They changed the material. Buried inside their new solid-state production specs is a detail so explosive it makes the current silver price irrelevant, a nanoscopic layer, an atomic solution, a material that doesn't just conduct electrons but controls them. Silver, not as wiring, not as decoration, not as a trace impurity, but as an active structural component of the battery itself. This is the moment silver stops being a precious metal and becomes something far more dangerous to supply chains, a strategic energy metal. And here's where the tension begins. Because this isn't a lab experiment. Samsung isn't publishing research papers for fun. They are building production lines. They are designing factories meant to supply millions of vehicles. And every one of those batteries needs silver, not micrograms, grams. Real weight, real atoms, real scarcity. Wall Street hasn't modeled this. Mining companies aren't prepared for it. And the market is still pricing silver like it's 2019. But technology doesn't wait for analysts to catch up. In this series, we're going to expose what this silver-carbon breakthrough actually means. Not emotionally, not politically, but mathematically. We'll break down the chemistry in plain language. We'll follow the demand shock step by step. And we'll confront the question nobody wants to ask. What happens when the future of clean energy requires more silver than the planet can supply? Because once you see the numbers, once you understand why this battery works, you'll realize something chilling. That last price drop wasn't a crash. It may have been the calm before the largest industrial squeeze of the decade. Here's the part nobody tells you. Every battery breakthrough in history failed for the same reason. Not money, not ambition, but chemistry. Because inside every battery, there's a microscopic battlefield you never see. At the center of it all is the anode, the place lithium ions return to when a battery charges. In theory, lithium should spread out smoothly, layer by layer, like fresh snow. In reality, it behaves more like ice spikes growing in the dark. Dendrites don't announce themselves. They don't show up on spec sheets. They grow silently, cycle after cycle, until one day they pierce the separator. And that's when physics takes over. Short circuit, thermal runaway, fire. This single flaw is why charging speeds are capped. It's why solid-state batteries stayed stuck in prototype hell for 10 years. Companies tried everything. Graphite anodes, too slow. Silicon anodes, they swell and crack. Pure lithium metal, unstable and violent. Each solution traded one failure for another, and that's why Samsung's move is so dangerous to the silver market. Because they didn't try to fight dendrites with brute force, they redirected them. Inside Samsung's solid-state design is a silver-carbon nanocomposite layer applied directly to the anode. At an atomic level, silver acts like a host, absorbing lithium ions and redistributing them evenly across the surface. No spikes, no needle growth, no runaway reactions. The silver doesn't just carry electrons, it controls deposition. That's the breakthrough. This turns lithium from a wild chemical liability to something disciplined and predictable. Suddenly, fast charging isn't dangerous, extreme cold isn't catastrophic, and energy density can increase without flirting with disaster. In energy technology terms, this is not an upgrade. It's a category shift. But here's the catch, and this is where investors in the energy and materials niche need to pay attention. This solution is material intensive. Silver is not optional here. It's not decorative. Remove it, reduce it too much, or replace it with something cheaper and dendrites come back immediately. That's not theory, that's published data, which means this battery doesn't scale digitally. It scales physically. Every extra vehicle requires more silver atoms. Every factory expansion locks up metal for decades. And unlike software, you can't optimize atoms out of existence. Now compare that to how silver has been used historically. A little in switches, a little in electronics, a little sprinkled everywhere. So little that price didn't matter. If silver doubled, manufacturers barely noticed. But Samsung just turned silver into a structural input, a line item that actually moves the cost of a product. And that single shift changes everything about supply, pricing, and geopolitics. Because when a material becomes structural, demand stops being elastic. Industries don't walk away. They don't substitute easily, they panic buy. And the auto industry is about to walk straight into that trap. Right now, the market still thinks silver demand grows in smooth, predictable lines. 2% here, 3% there. But solid-state batteries don't work like that. They introduce a step change, a vertical jump. And the moment this technology leaves the lab and enters mass production, silver demand won't rise, it will lurch. The question is no longer if this happens, it's how fast. And once we quantify that speed, once we do the math, Wall Street refuses to run, you'll see why the current silver price doesn't just look cheap, it looks impossible. Now let's put numbers on the fear, because stories are powerful, but math is merciless. Right now, before this battery revolution fully kicks in, silver already has a problem. The global mine supply sits roughly flat. Recycling helps, but only a little. And demand? Demand never sleeps. Silver is already being consumed by three unstoppable forces in the energy and materials niche: solar panels, electronics, and electrification. Even before solid-state batteries, the market runs a deficit. That means we're already burning stored silver just to maintain normal life. Now introduce Samsung's battery into that fragile system. Let's start conservatively, almost unrealistically conservative. Today, a traditional gasoline car uses around 15 to 20 grams of silver. An electric vehicle uses more, roughly 30 to 50 grams, thanks to power electronics, inverters, and battery management systems. That alone has already stressed supply. But solid-state batteries don't add silver to switches. They coat the anode. That's a completely different scale. Early research suggests silver loadings measured in grams per kilogram of battery material. Some designs hint at much more for long-range, high-performance vehicles. But let's stay cautious. Let's assume solid-state batteries add just 50 grams of silver per vehicle. That brings the total silver per EV to about 100 grams. Now zoom out. The world produces roughly 90 million vehicles per year. Even if only 10% of those transition to solid-state batteries, that's 9 million vehicles. 9 million times 100 grams. That's roughly 29 million ounces of new annual silver demand, created almost overnight. Does that sound manageable? It might, until you remember the market is already in deficit, and that's the low-end scenario. What happens if adoption accelerates? What happens if performance vehicles require more silver? What happens when multiple automakers copy Samsung's design? At 50% adoption and higher silver loadings, you are suddenly looking at automotive demand rivaling the entire solar industry. One technology, one application, consuming a quarter or more of global mine supply. And this is where the tension snaps tight. Silver mining doesn't respond quickly. It can't. New mines take a decade or more to develop. Ore grades are falling, environmental restrictions are rising, and much of the world's silver comes as a byproduct of other metals, which means production doesn't T-surge just because silver prices rise. So while demand jumps in steps, supply moves in inches. That imbalance doesn't resolve politely, it resolves through price. But here's the part most people miss. When demand is industrial and non-substitutable, price doesn't kill demand. It transfers ownership. Jewelry disappears, investment bars get melted, governments intervene, silver stops being something you trade, it becomes something you fight over. And remember, this isn't happening in isolation. Solar installations are still expanding. Electronics are still multiplying. Energy storage is exploding. Silver is being pulled in multiple directions at once. Which means the real question isn't, will silver demand increase? The real question is, which sector gets the metal and which one doesn't? Because the silver that goes into a solid-state battery doesn't come back next year. It's locked away for 15, maybe 20 years. Sequestered. Gone. And that sets up the most dangerous phase of any commodity cycle, the phase where scarcity becomes obvious, but solutions don't exist yet. In the next part, we're going to confront the biggest myth keeping people calm right now. The idea that recycling will save us. It won't. And once you understand why, this is where false comfort dies. Whenever a resource starts to look scarce, the same argument always appears. Recycling will fix it. Politicians repeat it. Analysts lean on it. Investors use it to sleep at night. But silver doesn't behave like gold. Gold is concentrated. Silver is dispersed. The difference changes everything. Nearly 90% of all gold ever mined is still accessible today. It sits in vaults, jewelry boxes, central banks. When the price rises, it flows back to market. Silver doesn't. Silver is industrial dust. It's embedded in phones, laptops, solar panels, medical devices, missiles, and now batteries. Tiny amounts spread across billions of products. Recovering it is expensive, energy intensive, and often pointless. That's why less than a fifth of silver is effectively recycled, and solid-state batteries make this problem worse, not better. Yes, they use more silver, but that silver is locked inside vehicles designed to last 15 or 20 years. The silver Samsung puts into a battery in 2026 doesn't reappear until the 2040s. Recycling doesn't relieve the shortage. It delays it by a generation. So now we're trapped between two clocks. On one side, demand is accelerating now. On the other, recycling relief arrives decades later. That's not a cycle, that's a gap. And gaps in commodity markets don't close gently, they close violently. Now layer geology on top of this. Silver ore grades have been collapsing for years. Mines that once produced double-digit ounces per ton now struggle to produce a quarter of that. More rock, more energy, more cost, less metal. At the same time, political risk is rising in the world's largest silver-producing regions. Permits are frozen, strikes are common. Resource nationalism is no longer a theory, it's policy. So just as Samsung's technology demands tens of millions of new ounces, supply is threatening to shrink. This is what traders call a pincer. Demand up, supply down, inventory is gone. And when inventories disappear, the price stops being set by traders. It gets set by desperation. Now zoom out even further. Governments around the world have mandated electrification. They've promised net zero. They've bet political credibility on EV adoption. But nobody checked the periodic table. If silver prices explode, battery costs rise. If battery costs rise, EVs become unaffordable. And if EV adoption stalls, governments don't reverse course, they intervene. This is where silver quietly becomes a national security asset. Not tomorrow, not in theory, but logically. If automakers tell governments, we can't build the vehicles you mandated because we can't get silver, the response isn't, okay. It's, we'll secure the silver. At that moment, free market pricing becomes secondary. Allocation becomes political. Industrial demand gets priority. Retail access tightens. And suddenly, owning silver isn't about price anymore, it's about availability. This is the phase where shortages turn structural, where markets stop asking, how much does it cost, and start asking, who gets it? And right now, most investors are still staring at charts, still debating technical levels, still arguing about whether the rally is over. They're missing the shift. In the next part, we pivot from danger to strategy, because knowing this without acting is useless. There are ways to position for this, there are traps to avoid, and there is a right side of this trade, but only if you understand how industrial shortages really play out. This is where most people get it wrong. And when shortages turn industrial, the winning strategy changes. This is not a normal bull market where you chase momentum, trade breakouts, and wait for a pullback that never comes. Industrial scarcity rewrites the rules. Because when silver becomes necessary, not optional, price discovery breaks. So let's talk about positioning without hype, without fantasy, without traps. First, understand the three ways people lose in a structural silver shortage. Trap number one, paper silver futures, unallocated accounts, ETFs backed by promises instead of metal. These work fine until they don't. In a real shortage, paper silver doesn't default loudly. It settles quietly, in cash, at the worst possible moment. When industry needs metal, they don't take delivery from retail investors. They bypass them. Paper holders get price exposure. Physical holders get leverage over reality. Trap number two, timing the perfect entry. People wait for confirmation, a clean breakout, a pullback to support. But structural shortages don't ring a bell. By the time the shortage is obvious, premiums explode, availability vanishes, and the dip never comes. You don't time scarcity, you front run it. Trap number three, assuming price will fix everything. In textbook economics, higher prices create more supply. In silver, that assumption fails, because silver isn't mined for silver, it's mined as a byproduct of copper, lead, zinc. If those markets don't expand, silver supply doesn't respond, no matter how high the price goes. So price doesn't solve the shortage, it exposes it. Now, what does work? In every historical industrial squeeze, the winners positioned early stayed boring and focused on access rather than upside fantasies. That means three principles. Principle one, scarcity beats yield. This isn't about interest, dividends, or short-term ROI. It's about owning something others must have later. When silver tightens, the question isn't, what's the return? It's, can you even get it? Principle two, simplicity. When complex strategies fail under stress, physical silver, clear ownership, minimal counterparty risk, that's it. No leverage, no clever structures, no faith in liquidity that disappears when everyone rushes for the exit. Principle 3. Think like industry, not a trader. Industries secure supply years in advance. Governments stockpile. Manufacturers sign long-term contracts. They don't speculate, they lock in. The smart positioning mirrors that mindset. Quiet accumulation before headlines, patience during boredom, and discipline when prices start screaming. Because here's the final twist most people miss. The real move in silver doesn't happen during excitement. It happens during disbelief, when prices rise and commentators say it's overextended, when pullbacks are called the top, when the market tries desperately to convince you nothing has changed. But the physical market knows. Inventory drawdowns don't lie. Industrial orders don't lie. Delayed deliveries don't lie. By the time the narrative flips from speculative rally to supply crisis, the positioning window is gone. At that point, silver doesn't trade. It rationed. And the people who prepared early aren't celebrating gains. They're simply holding something everyone else suddenly needs. That's how industrial scarcity ends. Not with a crash, not with a bubble pop, but with a quiet realization there isn't enough metal. Now we arrive at the part no chart can show you, because this story doesn't end with a price target. It ends with a regime change. Most commodity cycles follow the same emotional arc: neglect, curiosity, excitement, mania, collapse. Silver doesn't. Silver breaks systems. When an industrial metal becomes strategically essential, markets stop behaving like markets. They behave like supply chains under stress. And stressed supply chains don't ask permission. They reroute, they hoard, they prioritize. This is the moment where silver quietly crosses a line from tradable asset to strategic material. You won't see a headline that says, "Silver is now too important to be cheap." Instead, you'll see symptoms. Persistent backwardation, rising premiums despite falling paper prices, delayed deliveries, export restrictions, government stockpile rumors, temporary measures that never reverse. These are not signals of a bubble. They are signals of rationing. At that stage, price becomes a blunt tool. It no longer balances supply and demand. It simply decides who gets excluded. Small users are priced out first, then discretionary users vanish, then investment access tightens. And finally, silver flows only to whoever has contracts, power, or priority. History is clear on this. When copper was short, infrastructure slowed. When oil was scarce, wars happened. When rare earths tightened, exports were banned. Silver won't be different, just quieter. Because silver doesn't shout, it disappears. And here's the most important insight of all. By the time everyone agrees silver is critical, it's already unobtainable at sane terms. The real decision point isn't in the future. It's before the consensus forms, before analysts update models, before ETFs adjust narratives, before governments admit there's a problem. That's when positioning matters. Not aggressively, not emotionally, but deliberately. Because once scarcity becomes visible, the game shifts from profit to preservation. And the people who understood this early won't be asking, is silver going higher? They'll be asking, who's still selling? And that's when you know the cycle is over. Not because price collapsed, but because availability did.